You can be wrong 60% of the time and still be wildly profitable if you understand the mathematics of a proper swing trade. Most traders fail at swing trading because they treat it like scalping, panicking at the first sign of a reversal. Swing trading requires a fundamental shift in how you view probability and risk. In scalping, we seek a high win rate with a 1-to-1 reward-to-risk ratio. In swing trading, we accept a lower win rate, often 40%, in exchange for a reward that is at least twice our risk. The mathematics of swing trading rely on the trader's equation. Even with more losing trades than winners, the size of the winners covers the losses and generates net profit. To catch a swing, we must identify a strong trend breakout. We are looking for a series of consecutive trend bars with good bodies and small tails, indicating one side is trapped. When you see a strong breakout like this, the probability of a measured move up is high. This is where the swing trader enters, often buying the close of the breakout bar. This entry feels psychologically difficult because you are buying high. However, in a strong breakout, the market typically does not pull back immediately, leaving limit order traders behind. Once you enter, the placement of your stop loss is the single most critical factor. A swing trade requires a wide stop, usually below the bottom of the entire breakout spike. If your stop is too tight, normal market noise will tag you out before the move resumes. You must give the trade room to breathe. Because the stop is wide, your position size must be small. You cannot trade full size with a wide stop, or you violate your risk management rules. After the breakout, the market enters the channel phase. This is where momentum slows and two-sided trading begins. This is the hardest part to hold through. In the channel phase, pullbacks are common and necessary. A pullback is a pause in the trend, not a reversal. Novice traders panic here and exit. A standard pullback often retraces 50% of the recent leg. As long as the market makes higher lows, the swing hypothesis remains valid. During these pullbacks, swing traders must sit on their hands. You must accept that you will give back some open profit to capture the larger move. We can add to our position during a pullback if the signal is strong. This is called scaling in. We buy the breakout, and then buy the first reversal up from a pullback. The objective of a swing trade is often a measured move. We project the height of the breakout spike upwards to find a profit target. Alternatively, we look for leg counting. Trends often unfold in 3 pushes: the breakout, the second leg, and a final exhausted third leg. So when do we exit? We do not exit at the first sign of a red bar. We wait for a clear trend reversal signal or a climax. A common exit signal is a wedge top. This is 3 pushes up with overlapping bars, indicating the bulls are getting tired. Another major reversal signal is the major trend reversal. This happens when price breaks below the trend line, rallies to a lower high, and then dumps. If the trend is extremely strong, simply trail your stop. Move your stop loss up below the most recent major high or low. This trailing stop method ensures you stay in the trade as long as the market structure holds, removing emotional decision-making. Let's review a full swing trade example. Here, the market forms a double bottom, a common reversal pattern that starts a swing. We enter on the close of the neckline breakout bar. Our stop goes below the double bottom lows. The risk is defined. The market surges, then pauses for 5 bars. This is a tight trading range. We do not exit. We hold because the trend structure is intact. Finally, the market pushes up for a second leg equal to the first. We take profits on half the position at the measured move target. The remainder of the position is stopped out at break-even when the market eventually reverses. This creates a risk-free trade for the second half. Remember, swing trading is not about picking tops and bottoms. It is about capturing the meat of the move in the middle. If you try to enter too early, you get stopped out. If you try to exit at the absolute peak, you will likely exit prematurely. Context is king. Do not attempt to swing trade in a tight trading range. Wait for the market to declare a direction with a breakout. Swing trading requires patience. You might only find 1 or 2 good swing setups per week, depending on your time frame. But because the reward-to-risk ratio is high, You only need to be right occasionally to build significant wealth. Focus on the chart structure. Read the bars. If the trend bars are strong and pullbacks are weak, hold the line and let the trade work. Trade small, hold through pullbacks, and trust the trend structure.